Imagine a world where the economic epicenter shifts dramatically. Now stop imagining, because it's happening right now. China, a powerhouse that's been the factory of the world, is making a move that could rewrite global economic rules. But what exactly is this shift? Stay tuned to find out. China's post-COVID recovery was short-lived as the country's economy and markets were buffeted by three factors: a worsening real estate market, local companies laying flat as a result of regulatory crackdowns, and foreign companies pulling out as ties with the U.S. deteriorated. Property continues to be a burden on investment. Additionally, even with soft exports, industrial production is still below Chinese standards. We can see that mild credit data was supported by government expenditure. Moreover, deflation has also reappeared. The only positive development was a surge in retail expenditure, but even this was underwhelming when compared to a meager total from the previous year. Imagine you went to a program conducted on the ground nearby. You were able to see a lot of stalls with people selling different items. You paid attention to some of them and found they were Chinese products, and the people you saw were entrepreneurs. You felt very proud of them. However, the situation has now changed, and China is now in a pit. The Macquarie Group's Larry Hu and Yoshio Zhang observed three multi-year cycles in credit bottoming, earnings, and inflation in a recent note. A trifecta of policy resets was also witnessed by them, with macro policy becoming more supportive, regulatory policy loosening, and foreign policy becoming friendlier. And the following headlines appear to bolster that reset thesis. In an attempt to support the faltering real estate market, China intends to contribute at least $137 billion in low-cost financing to the country's affordable housing and urban village rehabilitation initiatives. Moreover, in a promising show of collaboration, Biden and Xi are expected to announce an accord that would see Beijing tighten down on the production and export of fentanyl when they meet. Finally, Beijing's pro-business policies have recently been reassured to both international and domestic companies by the authorities following investor anxiety caused by regulatory crackdowns in certain sectors of the tech industry. We will also witness Xi paying his visit to court U.S. business. We have seen several countries and organizations providing help to the people. However, can finances alone help the countries to rebuild them? Also, on the implementation side, we can see that developing countries are still underperforming. A few investors are setting themselves up for future prosperity. The financial advisor made well known in The Big Short, Michael Burry, is once again a longtime Chinese e-commerce giant, Alibaba and JD.com. Moreover, iron ore futures have risen above $130 a ton in the interim as a result of bets by commodity traders that the stimulus package will boost steel use. Hence, if Macquarie's reset idea comes to pass, that will support growth and guarantee that the government's goals for about 5% expansion stay on course. However, the property drag is a major cause for caution. China's economy has grown steadily for 40 years, making it one of the two biggest in the world. Hence, this is an incredible accomplishment that has helped hundreds of millions of people escape poverty and enter the middle class worldwide, often exceeding forecasts and surprising those who thought the economy would collapse. However, for a number of factors, that growth rate is currently decreasing. Like many developed economies, China is experiencing a demographic shift as its population ages. From 1980 to 2016, the country's one-child policy made this trend worse. A post-COVID-19 rise of economic nationalism is observed worldwide. Trade growth is slowing down as manufacturers in North America and Europe restore and diversify their supply chains, or their governments erect trade obstacles. These regions are already experiencing market saturation. Yet China's progress is also hampered by another factor. Its economy has long been reliant on excessive domestic spending on infrastructure and real estate, but the returns on these investments are rapidly declining. Due to the collapse of the real estate boom, local governments that depend on land sales for income are unable to pay down their debt. Imagine you are urgent about having a bulk of money for your sister's operation. You have a guest house, which you think might provide enough money to pay off. However, you tried several ways to sell off the property, but nothing worked. Seems like you need to find another source. Will this lead to a collapse of China's economy? Not always, or not during a financial crisis like the one that hit the West in 2007 to 2008. However, managing these issues will not be simple. Finding solutions might be challenging, and the outcome most likely will be considerably slower trend growth. We have calculated the extent to which China's economy is dependent on real estate and related infrastructure through collaborative research with Yuanqin Yang, an economist at the International Monetary Fund. Real estate had a direct and indirect economic impact of 22% of China's GDP in 2021, or 25% when accounting for imported content. However, the percentage increases to 31% when one accounts for infrastructure that services both residential and commercial real estate, such as highways, mass transit, and water pipes. 80% of that floor area is located in smaller, less affluent Tier 3 cities, which have not profited from agglomeration effects to the same extent as mid-ranked Tier 2 cities and wealthier, more successful Tier 1 cities like Shenzhen, Beijing, Guangzhou, and Shanghai. Moreover, the population of Tier 3 cities is already decreasing, property values are rising, and job openings are plentiful in many areas. Additionally, the US-led alliance is opposed by the China Semiconductor Industry Association, which claims that the penalties will hurt the countries and the world's semiconductor industries. Chinese advanced chip heavyweights were beginning to feel the pinch, including Yangtze Memory Technologies and SMIC. In order to counteract the consequences of the sanctions, Unisoc, a Chinese company that specialized in mobile chipsets, changed its strategy and concentrated on producing less sophisticated processors. Now, it is time for you to share your thoughts on the Chinese economy. Do share them in the comments. And there you have it, a deep dive into China's monumental economic shift, a transformation that's not just reshaping the giant nation, but echoing across the global stage. Before you go, take a second to hit that like button and subscribe to our channel. Drop your perspectives in the comments below. We love to see our community engage and share ideas. Thank you for watching, and remember, in a world where economics shapes our future, staying informed is key. Until next time, keep questioning, keep learning, and stay curious.